In this lesson, we're going to learn about internal control. This is another aspect of financial management and financial statement auditing that requires a high degree of professional judgment. Let's set aside for a moment the fact that we are auditors so that we can just focus on understanding what internal controls are supposed to do. As we've discussed in earlier lessons, management designs internal controls to achieve three broad objectives: reliable financial reporting, efficient and effective operations, and compliance with laws and regulations. Establishing an internal control system costs money. The more controls a company puts in place, the more policies and procedures, the more control activities required, and the more human and technology resources necessary. Let's recognize up front that companies can neither eliminate nor can they entirely ignore internal control risk. The right answer, like so many things in life, is somewhere in between and is based on a cost-benefit analysis. Management's interest in establishing a system of internal control is premised on sound business practices, including a reliable system control enables the preparation of accurate information, which allows management to make sound business decisions. Internal controls safeguard the assets of the company from theft, misuse, or accidental destruction. Management also hopes to prevent waste and other inefficiencies in the business by establishing control mechanisms to monitor these key activities. And internal controls play a critical role in preventing and detecting errors and fraud. Management will use some sort of risk management methodology to define the areas with key risks. And once identified, control activities can be designed to mitigate the identified risks. So let's talk about a few examples to give you an idea of what internal controls look like and feel like. Say we are looking at the sales cycle. What are the key risks here? Well, first of all, if we are using our hotel company as our example, we want to ensure that all the sales get recorded. What sorts of controls could management establish to meet this objective? Well, first, they may have a daily reconciliation process of the sales to the reservations. Maybe they reconcile the sales to the occupied rooms. We might have a security camera at the front desk to detect any thefts. A manager likely reviews the daily sales reports to ensure that the room rates and the occupancy rates appear reasonable. An even bigger area for risk might be in the restaurant and the lounge, as there might be more cash changing hands, as well as food and liquor inventory to safeguard. The general manager may require a supervisor to review and document all void transactions. Daily inventory counts of all the liquor inventory may be done. Order slips are probably pre-numbered and all the slips are accounted for at the end of each shift. Are you starting to get a sense of what an internal control is? Let's tie this back to our discussion on management assertions. What assertions are all these activities designed to ensure? That's right, completeness and accuracy of sales. Many of these also are fraud controls, but we will discuss those in a separate lesson. Management is responsible for establishing and maintaining a system of internal controls, not the auditor. The company is expected to design the system of controls to provide reasonable but not absolute assurance that the financial statements are fairly stated. Control systems are highly dependent on people and systems. If people are not trustworthy or they act in concert, they will attempt to override the controls to defraud the company. If the systems are not reliable and produce information that is incorrect, then the whole decision-making and financial statement reporting process are called into question. So in fact, there are some pervasive controls that we need to consider above all else before the detailed control activities can be deemed reliable. The control environment is the term commonly referred to when describing the actions, policies, procedures that reflect the overall attitudes and activities of senior management. If you look at the biggest corporate failures, the likes of Enron and Tyco and Bear Stearns and WorldCom and Nortel, all those stemmed from a dysfunctional control environment at best and a corrupt control environment at worst. It didn't matter how well the employees were performing their assigned tasks in these companies, as senior management was overriding the controls or establishing a tone at the top that disregarded the importance of ethics and abiding by corporate policy. We will pick up on this concept of control environment and its importance in the next lesson as we drill deeper into the topic of internal controls. Until then, don't stop till you get to the top. When you get to the top, don't stop.